Sometimes a single trade in the stock market can tell a more fascinating story than 1,000 news headlines. And today, we're diving into one of those stories, a huge, mysterious bet on a company that has been absolutely hammered. So, the big question is, what can one trade really tell us? Is it just a crazy gamble? Or is it a signal, a sign of a massive opportunity that almost everyone else is missing? Well, let's find out. This is the number at the very heart of our story, $82.5 million. I mean, just think about that. That's the total value of the shares being controlled by this one bet, made by one single anonymous trader. And here's the real kicker. This massive wager isn't on some hot, high-flying tech stock. Nope. It's on a company that's been crushed, down a staggering 70%. So we're going to dig in and figure out the logic behind this incredible move. Okay. First things first, to really understand the bet, we have to understand the crime scene. We need to look at exactly why Fiserv, a major player in the financial tech world, collapsed so spectacularly in the first place. And wow, this chart really puts the damage in perspective. From a high of almost $240 a share, all the way down to around 68 bucks. We're talking about a 70% plunge that literally vaporized over $60 billion in market value. Just gone. So what on earth happened? Well, it was pretty much a perfect storm of disaster. It all kicked off when management had to come out and admit that their own financial forecast was, and I'm quoting here, objectively difficult to achieve. That single statement just shattered investor trust, leading to a crazy 44% freefall in a single day, which was then immediately followed by a flood of class action lawsuits. A total mess. Okay, so right in the middle of all this fear, this litigation, this broken trust, one massive trader, our whale, steps up to the plate and makes this enormous bet. But what did they actually do? Let's break down the trade itself. All right, let's get into the nitty-gritty. Now, the whale didn't just go out and buy stock. No, this was way more sophisticated. They sold 15,000 put options with a strike price of $55. And for doing that, for taking on this position, they immediately collected $1.5 million in cold, hard cash. The bet they're making is that Fiserv stock won't drop below an effective price of $54 a share by February of 2026. Now, to really get this, here's a super quick primer. A put option gives its buyer the right to sell their stock at a set price. You can think of it like buying insurance against a price drop. But here's the key. Our whale was the seller of this insurance. They're the one taking the risk and getting paid upfront to do it. And this is where it gets really cool. Look at the different ways our whale can win here. Scenario 1, Fiserv stock goes up or even just stays flat. The whale keeps the entire $1.5 million premium, easy peasy. Scenario 2, the stock actually falls but stays above 54 bucks. The whale still makes a profit. And scenario 3, if it does drop below 54, they're simply forced to buy the stock at a price that's about 20% cheaper than it is today, a price they're clearly very happy with. This just lays out the strategic genius of it, right? If you buy the stock at $68, you only make money if the price goes up, period. But by selling these puts, the whale has created multiple ways to profit and has built in a huge margin of safety from the current price. It's a much more flexible position. So why that specific price, $55? Was that just a random number? No way. This is where the story pivots from just a clever trade to a really deep value investment thesis. Just look at this. At the whale's target price of $55, Fiserv would be trading at a price-to-earnings ratio of just 8.5. That is dirt cheap compared to its peers like PayPal and Block. And it's a completely different universe from its own historical average of 30. The market is basically pricing this company like it's on life support. And then you see this number, which makes the valuation case even stronger. Based on what are called discounted cash flow models, which are just a way of estimating a company's true worth by looking at its future cash, Fiserv's fair value is estimated to be over $137 a share. So here's the bottom line. At that $55 strike price, the whale is setting themselves up to potentially buy shares at a 60% discount to what analysts think the company is actually worth. This is the definition of value investing. You're trying to buy a dollar for just 40 cents. But a cheap price tag isn't enough. You need a reason for that value to get unlocked. You need a catalyst to light the fuse. And this is where the story gets really interesting and pivots to the future of AI. Let's talk about a new idea called agentic commerce. It sounds a little complex, but it's really simple. Imagine telling your AI assistant, hey, book me the cheapest flight to London for next Tuesday, and it just does it. It finds the flight, compares the prices, and buys the ticket, all on its own. That's the future, and it's going to need a whole new financial plumbing system to work. And guess who's quietly building that plumbing? Fiserv. Through some brand new partnerships with both Visa and MasterCard, they are literally developing the systems to authenticate these AI agents and secure their transactions. They're not making the flashy AI itself. They're making the picks and shovels, the essential infrastructure that the entire AI economy will need to run. This quote just nails the idea perfectly. Right now, the market sees Fiserv as some boring old-school payment processor, but our whale sees something totally different. They're betting that Fiserv becomes the NVIDIA of AI commerce, an absolutely essential piece of the puzzle for the next evolution of the internet. So, that's the big idea, a deeply undervalued company with this powerful, overlooked AI catalyst. But what does this all mean for an everyday investor? How can you think about this? Well, this exact strategy, it's called a cash-secured put, and it's something that many regular investors can use. Basically, you sell a put option at a price you'd actually be happy to own the stock at. If the stock stays above that price, great. You just keep the cash you collected, generating a pretty nice return. And if it does drop, you get to buy a company you already liked at the discounted price you'd wanted all along. You win by getting paid to wait. And that really is the heart of this entire $82.5 million bet. It's a calculated move. It's based on this one core belief that the market's extreme fear over past mistakes has created this massive disconnect, blinding investors to the company's real value and its huge future potential. And ultimately, that's the question this whole trade leaves us with. Is this stock just a falling knife that you should avoid at all costs? Or has this giant whale just given us a blueprint for a once-in-a-decade opportunity, hiding right there in plain sight?